My fellow investors, I am finally going to reveal today the holdings of my growth and my income portfolio. This is going to be a comprehensive video focused on cash flowing retirement and growing your wealth. For lack of a better word, getting rich in retirement while living off of your income portfolio, your income ETFs and what have you. Without further ado, I'm going to put my portfolio up here and let you take a look at the holdings. Now, I've been hearing that, in this space on social media, everyone in the high yield dividend space, high yield ETF space, they've just disappeared in the last few months. It's just gone silent. And I went to check, because I don't, follow everybody. I went to check and I found that to be at least mostly true. I mean, some of these content creators, they're completely gone. I've noticed some of them, I go to their YouTube channel and they're just gone. Their channel's dead. I noticed that the ones that are still around, they're in basically XDTE, the S&P 500. They just ran off to XDTE like scared little boys or little girls, and they don't want to invest. They've pretty much given up on, any individual ETFs, individual company stocks, with maybe the exception of Bitcoin. Some are in Bitcoin. But it seems like everybody has either ran to the major indexes, the S&P 500, or they've just diversified into everything, and they're not focused. They don't have conviction in anything. And I'm here to tell you, you don't have to do that, all right? You don't have to settle for market returns. I'm going to go over my holdings, and I'm going to explain in detail why I choose the specific tickers I choose, how you can consolidate and do better than 10, 11, 12%. Now, I'm going to say this also. Do I think this is for everyone? No, I don't think this is for everyone. As a matter of fact, I think this isn't for most investors. This is for people who, like me, they want to invest in alpha stocks. They want to get ahead. They want to grow their wealth. They don't want to simply, survive in financial independence or retirement. They actually want to grow and have something to look forward to. So I don't own one single share of XDTE. I don't own any VU. You know how many shares of SCHD I own? 0. I'm very proud of that. I haven't given up on my consolidated approach. And if you know anything about me, if you watch my past videos, I'm retired. I've been retired for a few years now. I'm doing this. This isn't theory. You're watching somebody and listening to somebody that's actually doing it, okay? I'm not saying I want to do this in the future. No, I'm actually doing this now. And I'm going to show you everything that I've learned and the best approach to take when it comes to cash flowing with anything like options funds or income ETFs. Now, this isn't financial advice. Always do your own due diligence. And I can't stress this enough. You need to have a deep understanding of what you're investing in. This is going to take work. This isn't going to be easy. If you want easy, and if I'm going to buy into a major index, I wouldn't buy XDTE. I would buy something like QQQI. I don't know why everyone is going to the S&P 500. The NASDAQ 100 is going to outperform it for the next 5, 10, 20 years. I would go into the NASDAQ, but that's just me. Now, going back to the portfolio here, what are the big problems and issues that retail investors have when it comes to trying to live off of high yield or trying to make this work? The main thing, the biggest hurdle that they have is they need to pick stocks with potential capital appreciation and not focus on yield, which I think a lot of people, I think that's where they're tripping up. And, make no mistake about it, that's the most difficult thing to do. It's also the most critical thing to do. I named this a high yield ETF's order of operations. This is how you pick the individual tickers. You need an underlying stock or asset with capital appreciation. This does not work if you don't have capital appreciation. You cannot focus on yield. A volatile stock is going to put out a large yield, but that doesn't mean you're going to have the capital appreciation, and then you're going, you invest in it. There's no good growth prospects for the underlying company. You didn't research it enough, and then the share price goes down, and then you mistakenly call it NAV erosion, and you get mad at the fund manager. And that's not what happened. You just bought into an asset that you shouldn't have bought into. That's the most critical point. You have to be able to pick stocks, or in the case of Bitcoin, an asset. And if you can't do that, it's just like growth. If you can't pick the stock, then you're going to fail. What you do afterwards, you can optimize what you do afterwards with whatever ETF or whatever ticker you buy into. But if you fail at this first point, and this is where most people are failing, and this is why you shouldn't overly diversify, because you're probably going to end up doing this. If you can't pick stocks, and I wouldn't recommend for anybody to go it alone. I think you should seek out help with this. There's a lot of great resources out there. People with good track records, that's what you need to find. People with good track records of picking stocks, and learn from them, and also do your own due diligence, do your own research on all of those individual companies. I don't care if it takes hundreds of hours. That's what you need to do. Now, when you have the underlying stock, now you may not necessarily have an ETF, income ETF that's tied to that underlying asset, but in many cases you do. The second step, is sliding scale leverage. So once you have that asset and you have deep conviction in that asset, that you will have capital appreciation, not just volatility, however long you want to hold it, hopefully at least 5 years, then you want sliding scale leverage. Now, I'm going to illustrate to you why this works and why this is important. Third, no strike price. So this would be something like Roundhill. Oh, by the way, number 2, that would refer to REC shares, growth and income ETFs. And the sliding scale, it starts at 1.05 and it can go up to 1.5 with an average of 1.25. I'll illustrate why this leverage is working. It is doing its job. All right, no strike price. That would be the Roundhill weeklies. What happens when you have this options overlay is, yes, you generate premium from doing covered calls and what have you, but the strike price will, cap your gains. And in most cases, maybe it's not so true in very low volatile assets or very specific assets, say a dividend stock, right? That may work, but more times than not, you get capped more than the premium that you collect from doing the covered call. The premium doesn't make up for the cap. That's why you see these underperform, in many cases, the underlying asset. So number 2 would be REC shares, growth and income would be an example. Number 3 would be Roundhill's ETF, which does not use strike prices. They use a proprietary formula to somewhat mimic a distribution that would happen with an options ETF. I would actually love it if someone released an ETF, and I hope one of the fund managers do this, with both those aspects working in the ETF. No strike price, some sort of proprietary formula to come up with the distribution amounts, and sliding scale leverage. Roundhill doesn't have sliding scale, it has fixed leverage. Now, the last one, full options overlay only. So this would be something like yield max. That would be your last resort. And I say last resort because sometimes the individual company ticker asset is not available in anything else. So it's kind of like, well, I don't see one in Roundhill. I don't see one in REC shares, growth and income. So this is the only thing I have if I want to cash flow off of it. So yeah, I think that's okay. But again, you have to revert back to number 1. And if you have too much volatility, you're going to need to go into equities over crypto. When you look at stuff like Bitcoin, especially strategy, and hey, I get it. I'm able to withstand a lot of risk and a lot of volatility, probably more so than the average investor. And even I, feel like this is kind of crazy. I don't like these wild swings. This has been stressful going down into the crypto bear market. However, you know, this might be a case where you need to put your Bitcoin or your strategy into growth and just keep it in growth. You don't need it in your income portfolio. Okay, so just have equities. If individual equities, such as, you know, like for example, Tesla is also very volatile. But if you don't even like the volatility of say a Google or an Nvidia, you know, you're probably going to have to go into something like QQQI and use that as your income. Okay, so you have less volatility on the income side, and you don't see those huge dips, because I know that that's really concerning for some investors. And hey, I get it. Like, I don't like this either, and I'm actually considering doing just that, just not buying more. I think I'll keep what I have, but you know, putting my anything Bitcoin related just into growth. And I believe there's some that have exposure to Ethereum, which could potentially be even worse. So yeah, put those things into growth if it bothers you. If you insist on having your income ETFs in something like a broad market index, you're probably going to have to resort to that, okay? And then you could have stuff like Bitcoin and Ethereum and Tesla in growth, okay? And then you just sit and wait. You don't have to worry about those huge drawdowns. And you still have the potential to have really good returns as long as you're able to, you know, withstand wild swings in the market and in those individual assets. Okay, now going back to sliding scale leverage, I want to illustrate this for you and show you why I picked this. You'll notice the majority of these tickers on the income side, they're in REC shares, which has sliding scale leverage. Now they also, you know, trade half of their assets under management. They have those with options overlay, and the other half of the assets under management, there are no options. So they're basically taking the biggest problem, right, which is a strike price capping you, and they're immediately cutting it in half, which was a good idea. But again, I'm not so sure that, you know, it would be better just having you know, doing something like Roundhill does, and then having sliding scale leverage. Okay, so why does this work? This NVIDIA's chart goes over technical analysis, but I'm going to try to keep this pretty simple because I'm not sure how many people will understand, you know, or know too much about technical analysis. But very simply, just as an example of what REC shares can potentially do, when you look at the relative strength index, okay, and you'll see here on this chart that NVIDIA's stock, it dipped below that lower Bollinger Band, and it had a really low RSI, you know, hovering above 30. And this shows that it's oversold. So what they can do potentially with that sliding scale leverage is they could now turn up the leverage because there is upward pressure. In other words, there's buying pressure on the stock. And when that stock inevitably flows, you know, up, it can capture that leverage, and you could see greater capital appreciation that way. Now, you could also do the same with a high RSI, okay? So in this case, you could see the relative strength index of NVIDIA stock is over 70. That means that it is overbought and there is downward pressure on the stock. Now, they could dial that down to 0.05, right, next to nothing, and ride that down, taking away that leverage. This is how they're doing it. Okay, now can it backfire? You know, going back to the lower RSI. Yeah. You know, it could have a low RSI of, you know, around 30, and you know, maybe a black swan event or a gray swan event happens, and the stock goes down even further with a little leverage. But it's all about probabilities, right? The probability is that it's going to recover. It's going to mean revert. So when you see these mean reversion spikes, that's the time where you can either lower or raise. Okay, that's how REC shares can do this. There's proof that it's working. We have 3 stocks here. We have NVIDIA, NVDW, and we have NVII stock. You can see that it's actually outperforming the options fund, and it's also outperforming the one that has no options, but it has a fixed leverage. So we could see that it's working. What REC shares is doing is working. That's why I'm putting my money into these ETFs. In some cases, these REC share growth and income ETFs, they are actually outperforming the underlying stock, which is unheard of in income ETFs. Here's a comparison of VU and SCHD to NVII. Now this can only go back to May of 2025, so not quite a year. VU overall total returns 13.78, SCHD total returns 18.54, NVII total returns 47.43. What I like about NVIDIA too is when you look at this chart here, you'll see this consolidation that's happened. It looks like it's from August to April of this year, August of 2025. You see this long period of consolidation, and that gives me confidence that we're going to see a surge in the stock price. So I think this is a really good buy now. Now the thing with NVIDIA, when it comes to these semiconductors, they don't fab. And fabrication, it has really high capital expenditure costs, and they don't have that problem. They are a designer, so they don't have the huge capex that these other fabs have, but they're also doing well, and we're going to go over some of those. But I really like NVIDIA, and I think this is a really good holding to make kind of your primary holding if you're interested in doing something like this. It's not just the underlying stock, it's also the sector that it's in is going to be very strong, I believe, for 5 to 10 years, maybe longer, but I think we have at least 5 years. And also the mechanics of the ETF, okay? You have to understand the mechanics and why it's working and how they're doing so well with total returns. Now, when you look at my growth, these are, I have a few other smaller positions, but they're really so small, not worth mentioning. But these are the majority of my, this is the majority of my holdings. And now really quickly on Tesla, and you'll notice I do have TSII, which is the REC shares income fund. If I can go back, I maybe would scale that position back a little bit. The reason I think it should go into growth primarily is because I think there's going to be, further growing pains with Tesla. Now, I do have optimism for the remainder of this year. But with Tesla, it's been a slow burn for them because they're vertically integrating the company. And when you vertically integrate a company, you have to, take the time to build out factories and, make sure that you can supply yourself with everything that you need for, all your future projects. And everything is integrated. And that takes years to build out. And that's why it's, been kind of stagnant. At these current levels, I would say it's still a pretty good buy. But, because of this vertical integration and the build out and the long wait for everything to come together and for that AI flywheel to really go into effect and start having a big impact on the stock price, I think you may have to be patient. But I do look forward to 2027 and yes, again, the end of this year. I think we're going to see some impact on the share price and on revenue. We're going to start to see those new revenue streams come in. So but I see it as easily a 20-year hold. I think it's a great growth stock to hold, for the next decade easily. And then, like I said, further into the future even. And then I have Bitcoin. Again, if you can't handle the volatility of, say, Bitcoin or strategy in your income funds, then just put it in growth. You don't need it for income. You could just do equities. I don't know why people insist on putting it into their ETFs and then they say, well, I can't handle these big drawdowns. I expect drawdowns. In fact, I expect some years in pretty much all of these investments to have red years. I don't look at 6-month windows and panic because I know what I buy into. And you have to know what you own, because eventually you're going to be shaken out and you're going to sell at a loss. Okay, these are long-term holds. Okay, you can't have a mindset where a 6-month red window throws you off, or even a year. There's nothing wrong with just putting it in growth. If you want to, and you could just do Bitcoin, just put Bitcoin in your growth portfolio. I have some Solana also, and that's DFDV, that's Solana Treasury. The rest are, so small, they're not really worth talking about. And then income. So I do have MSII though, which is based off strategy. So does that mean I sold out of my MSTW? Yes, I sold out of my MSTW and MSTY. I am completely in MSII. I believe in sliding scale leverage. It is working, and as long as there is an uptick in the stock and there is a bullish trend in the stock, it will work, and we have proof of that. I do have some TSII again. I think I should have went heavier, and I wish I would have went heavier into semiconductors. In fact, I would say, if you're starting now, that's probably a good idea. If you heard what Elon said recently, he was talking about semiconductors, and he even has a terafab built out, right? So he has, in the future, he'll be able to vertically integrate semiconductors into his own businesses. But he told them, Micron and TSMC, hey, if you guys build chips, however many you make, I will buy them. He said that, I will buy them. That's one company. There's huge demand for memory and for GPUs and compute. They're sold out for the rest of this year and next year. Okay, so all the inventory is completely taken up years in advance. That's how much demand there is. And we're just getting started. That's why I say, I think we have at least 5 years potentially where semiconductors do really well. So this is how the global AI disruption or takeover timeline is going to go. I broke it down into 3 basic phases. You need semiconductors, data centers, and AI infrastructure in the first phase. So that's why this is very important, right? It all starts there. There's also energy bottleneck. I think that there's some really good opportunity in some stocks for energy, if you could find them also. And then, from there we have AI agents and automated companies. This was one of the major threats for Microsoft. You have macro hard, being developed, and these are going to be automated companies that replace entire software companies. And then eventually we're going to have physical AI and automation. That may be a few years off until we see any meaningful growth in that space, but that would be, for example, Tesla. But for now, we need semiconductors and we need energy, and we're seeing huge growth. So going over these holdings, NVIDIA is my top pick. Some people would point to Micron. Yes, we need memory. Now, Micron has gone up, was it 400% this past year? I think investors are going to be taking profits. And on top of that, because, to meet the growing demand that they have for memory, Micron has had to build out, I believe it was 2 or 3 factories, I think a couple in Asia, to meet this growth. So their capex is going up, and that can hurt the stock. So there's a couple of reasons why, there may be some pullbacks. So look for pullbacks, in that stock. Now, there's not currently, anything specific to Micron as far as income ETFs go. Now, it is in the holdings of Chippy. So, that's why I like Chippy. It does give you, a lot of exposure to several semiconductor companies. But again, some may, go through some rough spots because of capex and capital intensity it takes to build out and fabricate. Well, TSMC is doing that too. TSMC is building some factories north of Phoenix. They're not going to be the same speed and quality as what's being fabbed in Taiwan right now, but eventually they will get there, and that's a good thing because of that obvious threat. So I think, TSMC, they're setting themselves up for the future, and that's why I'm saying if they're building now, right, they're building out their fab fab capabilities to grow in the future, I think that really gives us several years here to kind of ride the wave of semiconductors. And so I think for income, because the income ETFs, it's very much what is hot now. Just because I think Tesla is going to do good in 20 years, it doesn't mean that that's necessarily good for an income fund now, because there's going to be some volatility and some drawbacks. Whereas if you have something that's steadily growing and there's huge demand right now, that's what I would look for with my income ETFs. And that's why I like these semiconductor ETFs. So we have TSMY. Now, didn't you just say you don't like covered call ETFs? Yes, but there is no Taiwan semiconductor that, from Round Hill or from RecShares that, doesn't use a strike price and it doesn't have sliding scale leverage. So TSMY is it. It's actually outperforming Chippy. So I have a small position in TSMY. I have a little hood and CoreWeave. I really like the CEO, and with the huge wealth transfer that's coming up, I think it's very promising. AMDW, there are no AMD stocks for RecShares, growth and income. I had to revert to Round Hill. So Round Hill doesn't have that strike price. I also like AMD. They do not fabricate. They are also a designer like NVIDIA. Okay, so if you wanted to diversify a bit and put some money into there, I would say that's a secondary option though. I would have my NVII position to be larger than AMDW. And I really like Avgo also. AVGO, I have AVGW. I also have some Google, some AI play there. I have SSK, which is Solana staking. This is going to change from month to month, but I believe the current yield is over 25%, like 25-30%. Okay, but that's going to go up and down, obviously, depending on a few things. So if you want to cash flow off of Solana, now you have to understand Solana, of course. That would be important. So you have to do your due diligence. Solana is faster and cheaper than a lot of these competitors blockchains like Ethereum and Bitcoin. And there's a really good use case for AI agents using Solana for making payments online. So I see a lot of growth potential with Solana, but it's also a nice way to cash flow, and you don't have to worry about options. You are not going to get capped. And then Meta, I think, they have some potential for, hopefully overcoming this disaster that they had with the metaverse and putting more focus on AI and turning things around. Hopefully Microsoft can do that too. And then of course Chippy, again, I would have a small position in Chippy because it uses just a pure options overlay or covered calls. It is diversified, and I know people like that, so I like it, but again, it's a smaller position to NVII or even AMDW. But I do own some. Now, there are also RecShare individual stocks filed, and it's in the works, and we could see a list of them here. There's some that really stand out to me. Now, as soon as these hit the market, I'm going to switch if I have them. So for example, if you have them in a pure options overlay like a yield max, or you have them in Round Hill, I would switch them to RecShares growth and income. So that's going to happen with AMD. I'm going to sell out of my AMDW and I'm going to move it to, I'm assuming the ticker might be something like AMDI. It's also going to happen with AVGO or Broadcom. I'm going to switch out AVGW and go into, I'm going to guess AVGI it might be. And then Google is another one I'm going to swap. Meta. And I think Palantir is promising that they've had a big pullback recently, but their revenue and their profit margins are increasing. I think it's possibly undervalued, so it's promising. Now, I sold out of my Palantir stocks. I had it in my growth. I sold out of it pretty close to the peak, and I just haven't bought in again yet. And then we have Microsoft. I know a lot of people are interested in Microsoft. There's been a huge pullback because it's a software company. I think there's a lot of fear associated with that, but that's, I think it's also promising. Amazon has huge CapEx, and that's why they've been, somewhat stagnant in the past, but Amazon, I think, is another good one for growth. And at some point, it's going to be a good option for income ETFs. Now, when it comes to strategy or Bitcoin, there is that risk because of the Bitcoin winter, Bitcoin bear market, that an options fund or an income fund is going to reverse split. That's a definite, risk that we take in holding it. I've continued to hold mine. I believe that strategy is going to 4x in the next 2 years, and I think that's pretty conservative. If it 5x in the next couple of years, it wouldn't surprise me, or more. And I say that based off of the growing satoshis per share and the accretion that strategy has been able to implement, and that combined with a surging Bitcoin price could really make something like MSII just explode. So even if it reverse splits, it's still going to outperform the market. It's still going to outperform SCHD. All right, this drawdown doesn't matter. I don't want to see a reverse split, and that's why I would say always reinvest as much as you can. And I think that's key. Just, reinvest as much as you can. Keep adding shares to your income portfolio. Add growth when you can and when there's good opportunities, but keep buying these income ETFs, because if you're in something super volatile like Bitcoin, there is that chance. But again, it's still a long-term hold if you understand it, because you understand that this is an alpha asset, and this is something that can beat the S&P 500. It can beat the NASDAQ. And so I'm okay holding it through downturns and even bear markets. Although I would argue also, you probably want to try to sell out before the bear market, or limit your exposure before any potential bear market, or just go into growth. Put your Bitcoin in growth. Don't worry about cash flowing it. You can use equities. This is working, guys. I am living off of this. Again, I don't own, any S&P 500, and I'm doing well. I've taken vacations. I've done some traveling recently. I'm still doing well. I'm paying all my bills and then some. I'm able to reinvest every month. I'm doing great. And I have half of my portfolio in growth, and it's sitting there waiting for the future. I can use it, for margin if I choose, although I don't go heavy into margin, and I could trade options on my growth. And I do think it's important. I think people should be shareholders. If you believe in a company, I don't think you should just put all your money into ETFs. I think you should be a shareholder. It's good for research and development and the growth of the company. So, definitely have some growth. Don't put all your money into ETFs. That's just my opinion. And then if something goes wrong, you always have your growth to fall back on. Now, if you haven't watched my last video, go watch that video. I make 2-year projections on some of the most popular ETFs and stocks on the market, and I rank them in total returns, what I think they'll do in the next 2.5, well, now it's 2 years, and I show you which assets that I think are going to perform the best. I haven't had anyone challenge me on it. I don't know why. No one's interested on challenging me on my projections. Maybe they think I'm right. I guess they think I'm right, or they're not confident enough to tell me I'm wrong. Maybe that's what it is. So anyway, stay tuned. I know I don't make a lot of videos, but as you can see, my portfolio is pretty consolidated and simple, and I've already covered a lot of these holdings, in my past videos, and I just don't see a reason to make a ton of videos, I guess is what it is. And we've been beaten down a lot. I think a lot of people are, they're not doing too well. They're not optimistic. They're depressed maybe. But I'm doing fine. I'm doing great. I'm kind of glad that we saw, this big drawdown. We have the Bitcoin winter and war, potential inflation, high oil prices all at the same time. And I can say with confidence that I'm okay, and that, you know, after seeing this, I know I can make it. This is working really well. I'm going to go ahead and update you guys every once in a while. But again, you know, it's a pretty simple portfolio, so I don't make a ton of videos. Don't expect a video every week, although who knows, maybe in the future I'll start making more videos. But this is a comprehensive video for you to, you know, help you know and realize that, hey, you don't have to give up your dream of high yield dividend investing. All right. And you don't have to just accept market returns. You can thrive. And not only can you know, live off your investments, you can get quote unquote rich in the future if you know how to pick the right assets. And that's key. Get help. Don't try to do this alone. And I would also say, you know, those huge communities with thousands of people in them, you're just going to get pulled in a million different directions, and it's not going to help you. I would say follow just a handful of people that are going to help you do your research on these individual assets and help you understand them. There's books out there to read. There's all kinds of free resources if you want to learn about these individual assets, and you know, you'll be fine. You're going to do okay. All right. You don't have to give up your dream, and you don't have to, you know, totally abandon, you know, don't do anything crazy like, you know, buy up a bunch of bonds and try to live on it. Okay. That's it. Thank you for watching, and stay tuned for another video. I will update you in the future.